Ira Epstein of Linn Associates with your agriculture update for this Monday, the 11th of March, 2019, and we're just approaching 3:20 p.m. Central Daylight Time. It used to be standard. I think it's daylight now. So when we take a look at what's going on in the grain market, again, another hit. We're just not getting the export business we need. The market's in search of finding a value where we're competitive on world markets and where world markets stop maybe falling in price as well. There's combinations here that are not pretty. It didn't help over the weekend when you heard that the U.S. and China are still writing a draft of what they've agreed to, and they're running into lots of bottlenecks. So that pushed the market, saying now we're not at that point yet. The stock market, though, flipping it around, didn't care. And even with the problems for Boeing with losing another plane over the weekend, we don't know what that means. Boeing stock was down double digits at one point. It recovered late in the day, still, as I saw it, still down, but nice recovery in all those markets. The dollar, pretty stable right here, and we can see that the gold and silver is still down a bit. So when we take a look at the soybeans, they have now retraced 50 cents from their high that they made here on a closing basis of 925.25 on the weekly area chart of closes. When we go to the daily bar chart, you can see how the market is still slipping away right through here. And when we go to the swing line study, you still don't have a trend in the sense of a pattern of lower highs, lower lows, or higher highs, higher lows. You have that one pattern of a higher high and a lower low. Unfortunately, that is not a trend. What we did get last week, and right through here was when it happened, this day on Thursday, both the 18-day average of closes and the 100 were at the same price, 917.5. A bearish crossover occurs when a shorter-term average gets underneath a longer-term average. In this day, the 18 under the 100. That's often a sign that the market is now getting to the point where it's going to try to make a lower low because it's a bearish thrust. So you'd be looking at that low, seeing could it take it out. It frankly did so today, so it's met that requirement already. When we look at where the market is in relation to the Bollinger Bands, you have to understand what a Bollinger Band is. It is an algorithm designed to keep the market trading within the band. But what's important is, what is the band doing? Is the band breaking down, like it is here, the market riding to downside, upside, or sideways action? In this case, what we have is a market where the market price gets under the lower band, seems to pop back up like it did last week, and then back under the band again. That's a sign of bearishness. The odds of staying under that band consecutively more than a day or two at a time are not large. 5% of the time the market will stay over or under the band, and I count each consecutive break under it as one of those percentage points. So you have today under that band. If you take a look at Friday's close, you were under the band, but if you go to Thursday's close, you weren't. So you have 2 consecutive days in a row under it. That gives, the way I look at the market, a 3% chance that the market will be under that tomorrow. Also, you've got a Tuesday. Tuesdays are notorious days for market technicians. They like to talk Tuesday reversals. Does it always work? Nah, nothing always works. But you're oversold. You can see that as you get to the slow stochastic reading. 2 days under the band. I think the bears might say, well, maybe I can wait and get a better spot to sell. That's about all that I'm saying. In the meal market, you can see that different than the soybeans, you're in a bear trend. You have lower highs, lower lows. That in itself is bearish. Today's close at 301.30 was under the lower Bollinger Band of 302.70. On Friday, the market closed at 303.70, under the lower band of 304, but the day before, it was nowhere near that. So I still contend that the pros, on the first challenge of a Bollinger Band, they're often taking some money off the table, trying to come back in on rallies in a market that's in an established downtrend. The problem right here is the market's oversold. So the question is, when you're oversold, do the pros still want to keep selling it? That is going to be a question. In soybean oil, a little different story. If you'll notice, both the blue and the red, they're called the K and the D lines respectively, they are both under 20. You can see that today. They were under 20 on Friday, and they were under 20 on Thursday, and even going back to Wednesday. That's called an embedded reading. It occurs when you convert from being oversold to locking in a bearish trend. Now, with this bounce in the market, what I would expect is until the red line closes over 20, the bears are waiting for a good rally to hit the market again. Lose the 20 reading. In other words, get the red line over 20. You don't have to worry about the blue line. Close it there, and the odds would favor a rally to the 18-day average. So right now, that's not what's occurring. You could get a rally there, but the odds just favor on some rally here. The pros are going to try to keep selling this market. The corn market, like the other parts of the grain market, lower highs, lower lows, bearish. Now, today's settlement at 362 is just above the lower Bollinger Band of 361 3/4. On Friday, you had a settlement that at 364 1/4 was literally right at that low, and you were on the day before at 365 1/4 under it. So you're hugging that lower Bollinger Band. It's not the same as closing under it. You're hugging it. And that is a bearish sign as well. Yes, when rallies come, I would expect to see the pros selling the market. Again, you got to be concerned with the oversold condition. In the wheat market, it's just a blowout to the downside. And the difference here, it's more like soybean oil is developed. See that? That's an embedded reading. So what I think happened is a lot of the pros came out of the market in front of Friday's USDA supply-demand report, the world supply-demand reports, and when the market did that and it saw the bearishness that came into them, sort of paused, and today it's a resumption of that downtrend. In other words, you didn't rethink the positions. Still, to me, this, until you lose the red number under 20, just as an anchor pulling down all the other grains. In the sugar market, we have both numbers under 20 today. On Friday, both numbers were under 20. And on Thursday. That's called you just embedded this reading. So until the red line's back over 20, on further rallies, I'm looking for the pros to step in and try to hit this market, keeping that there. Now, if you lose the embedded reading, get over 20, then I'll look for the 18-day average to come into play. Right now, this market very much in the bear camp. Coffee in the bear camp, but oversold. Different than the sugar market, not embedded reading, just oversold. I'm going to still look for resistance at the 18-day average of closes and support against the lower Bollinger Band. In the cocoa market, this is really no trend. You have a pattern with the red lines of lower highs, but you also have higher lows. So what you now need to do is figure out which one of these is going to win out. By default, the way that I think, because the market's under the 18-day average, the bias is down. At the same time, it's oversold. I just look at a market like that and go, I don't know what to do with it. In the cotton market, I don't know why I skipped that, but I did. Higher lows, higher highs. So I've got an uptrend still at work. I have divergence. This market's got momentum pointing down, and it's not holding rallies well. I'm looking to see if the 18-day average can hold. You know what would turn this market bearish? If on this pattern, if you got under 72.51, you could have lower highs, lower lows under the 18-day average with already momentum pointing down. That could be a bad signal for the bulls. In the cattle market, today the market closed very, very close to unchanged, not doing an awful lot one way or the other. It's tried a little bit of everything. If we look at Friday's close, you were at 120.95, today 120.25. So 70 lower in an overbought condition, no trend, lower and low, higher high. Feeder cattle market went back down today, challenged two support levels. Let's go to Friday so you can see this. Remember, we had a cattle on feed report come out on Friday. In looking at the report, I didn't see much of anything, but what I did notice is that looking at the daily charts, you would hit the lower Bollinger Band 3 days prior, then the upper band going on Friday, then you get the report at the end of the day. Today you pull back, go to the combination of the 100-day average and 18, and then the market finally at the end of the day goes to 147.40 under. So Do I have a trend here? I don't. I've got a market fighting in two support levels, but a higher high and lower low. It's already hit the Bollinger Bands, pretty much caught in sideways action. Where we're getting a pop in the market, and one of the things we were talking about is, you know, the trade had been looking for Chinese buying of pork. With the swine flu that's going on there and other parts of Asia, we've been looking for export business. On Friday, for whatever reason, the market made a large run up to the upper Bollinger Band, got itself overbought, certainly not trending. Now, normally that's where I would think money's coming off the table, but today the market extended, went to the next resistance level of the 80.07 and closed near that. So, pretty strong move in the marketplace. It's using this now until it breaks through it again on the downside is a base area. I think you can see that. Will it be able to continue higher? Well, my job isn't to predict here. My job in this particular tape is just tell you those are the resistance zones in an overbought market that I don't define as trending. This coming Thursday at 12:30 p.m. Central Daylight Time, we are going to have a live webinar. I've already sent out the invites for you to come. It lasts between 30 and 45 minutes. You bring your questions. If I don't know a symbol, help me out with it. I don't know all the ETF symbols there are. But to me, a chart's a chart, so we talk strategies, we talk trade ideas. I try to instill what my charting course is all about. For those of you that come in, I'd like to tell you a little bit about the charting course at that point in time. I think you'll find it interesting and maybe a way for you to buff up some of your trading strategies. How you get it's by invite only. And as I said, the first group of emails were all sent this morning. If you didn't get one, call my staff. It means you're probably not going to get it. I don't have you on our mailing list. Give us a call at that number. Seating does fill. I'm going to tell you that. And by the time you get there, when I start at 12:30 p.m., I start on time. So within a minute of it, I'm going. Don't try to come 10, 15 minutes later. You're going to miss the whole opening and what we're doing at the very beginning. So again, 866-973-2077. Give us a call.